Daniel, quick question. If obviously I'm going to be presenting some information. I haven't used WebEx in a while. It is asking me to change some system preferences on my computer, and I have to actually quit WebEx to install those. Is that routine?
I don't think so. I'm promoting you to a presenter right now.
Oh, okay.
Let's see if that changes anything on your side. You should be able to share your screen. And if you can't, I have your presentation and I can share it on your behalf.
That's
All
okay.
right.
I'm just going to quit WebEx really quickly, and I will be back in 1 minute.
Okay. In the meantime, let me share my screen.
Hey, Daniel, if you're still taking requests on topic suggestions,
Yeah.
I hear quite a bit, and I'm new to this topic, but I hear a lot of people talking about LLCs, and I'd love to know more about that kind of thing and like shopping for mortgages and how to protect your personal credit while you're shopping for mortgages. It all seems confusing to me.
Okay. So the good news is I did find somebody to speak about mortgages. So we have a local person, I believe the person's from Portland, who will be coming in March actually to speak about mortgages. We might be able to bump that up to the end of February. But so we've got that there. For LLCs, we do need to bring more people in on that subject, but I would actually ask you to go back, if you can see my screen right now, to where is she? Jillian Anderson. There she is. She had an interesting talk, and it was she used to be a record label producer, and she had a rock and roll themed presentation. But she was a lawyer that did speak some on LLCs as well. But you're right, we need to get some more in there about that. Are you interested in LLCs in terms of putting rental homes inside them,
Yeah.
or something else? Okay.
Yeah.
Okay.
Thank you.
Yeah. Making a note of it. Anybody else?
Daniel,
Yes.
just have you considered having someone on to talk about REITs, like their listed ones, their unlisted ones, there's how to evaluate between all the different options out there, what factors to consider, how it compares to other types of real estate investing?
That's a great topic. I'll start looking for that.
Thanks.
All right. Anybody else?
Yeah, hi. My name is Sophie. I'm new here.
Hello,
I was
Sophie.
hi. I was just wondering if you have a video or something about like newbies, somebody trying to start in this area.
You mean in terms of just what the club resources are, or getting started in real estate?
In real estate. And
Okay.
second question, I was wondering if it's only for real estate or if you have like another chat for like investment, or is it just real estate investment?
Yeah, this particular group is all about real estate investment, and I try to bring in as many different topics on real estate as possible. LLCs and mortgages are one we need to get more in. But if you're new to this club, let me show you our Intel SharePoint site. This is available internally only, and I'll drop it here in the chat box. If I can see. There we go.
Thank you very much.
Some of the resources that are available here is, of course, that we have live events every Friday at 12. Right now, for those of you that are on the line, if you would like to receive invitations to these live events, I highly suggest you go over here to meetup.intel.com and click on follow. I know there's a certain portion of people that don't get the announcements that way. That really is the most reliable way to get the announcements. And it also lets us, if you come over here to the meetup.intel.com and you want to unsubscribe, that's the best way to do it as well. We've had a couple of people that have come to me and said that when they try to unsubscribe here, they're not able to. If you're not able to, and if it's not taking you off the list, please just email me directly. I can manually take you off the list. I don't want people on the list that don't want to be there. So just let us know about that. The next thing to show you is that we have on meetup.intel.com our list of upcoming speakers, including Caleb Guillaume, who's going to talk about the AND asset. This is also known as infinite banking. And basically what it is it's opening a specialized life insurance policy and using it for storing your cash while you have cash on hand. I saw a discussion over in Money Matters about where should you put your cash when you're in between investments. And this is a really good solution to that. You'll get 3.5% to 4% interest and a lot of asset protection, in addition to being able to have a life insurance policy and the ability to pass it down to future generations without going through standard probate channels. So there's a lot of interesting things with this. Then in Work Week 8, we have Jason Hartman, who is the host of the Creating Wealth podcast, and he runs a brokerage for turnkey properties. He's a great speaker. I highly recommend his podcast if you've heard of it. And then we have a few other people that are not yet on the calendar, and I need to put on the calendar. Okay. In terms of previous...
Jason, quick comment. The link that you shared, it says permission required. Is it
which one?
SharePoint? The SharePoint.
Yes. Yeah, the SharePoint site. The SharePoint is something I need to add you to. Okay. If anybody knows how to make it public, can you please contact me? I have hunted and pecked all over, and it's a pain in the neck. So please contact me if you know how to make it public. It's the same with the previous speakers page. I know a lot of people have emailed me, and really it's an email that I receive, and I just click on yes, but I'd like to make it public. All right. For previous videos and of speakers, we have the video portal, which is here. So we have all of our previous speakers, Adam Adams talking about virtual assistants, our market updates. Andrea Duane did a market update for California. Bob Bowman talked about purchasing office parks. Courtney Buck is the ambassador from the CDC to the World Health Organization, and he spoke about his business practice. We had Jason Teal down here, who is the head of acquisitions at Fannie Mae, came in. We've had a lot of interesting and good speakers. 1031 Exchanges and DSTs by Melissa Orman, Large Scale Multifamily Investment by Mark Kenny, Whitney Sewell also talking about real estate syndication, Self-Directed IRAs with Scott Marr, Buying Farmland in Colombia and South America by Stu Kerber. I'm sorry, not Colombia. This is the Columbian River Valley in Oregon and Washington. Yeah, so a lot of good speakers here. Oh, that's my email. All right, next we have Yammer, and we have the links to all the people that are on the leadership team. So make sure to check that out. Here's the group that makes this club run. Very grateful to all of their help. The Yammer group as well. If you have questions and you want to ask them to the community, we have a Yammer site. Please take advantage of it. And I think that's all we have here. I've got the topics that were suggested. If there are any other topics that you want to hear about, just put them in the chat. And so with that, I'm going to turn it over to Logan. Logan is a broker in Kansas City.
Both dad's and mine.
Let me make sure to mute yourself if you are here. I'm going to mute.
It's like a 401.
There we go. So hopefully you can still hear me. And you can still hear Logan. Logan is a broker from Kansas City. I'll let him introduce himself. One fun fact about him is that Logan used to play for the Oakland Raiders. And I'm sure that maybe he has some thoughts about the Super Bowl this week as well. So Logan, I'm going to turn it over to you. Oh, I'm unmuting you. What is this?
Can you hear me now?
Yes, I can.
Okay, great. Well, thanks, Daniel, for putting this together, and thank you for having me here.
Really quickly, Logan, too, if people have questions, put them in the chat box, and I'll read them to Logan when he wants to stop and take questions.
Yes,
Go ahead,
absolutely.
Logan.
Fantastic. My goal today is to give you guys and gals kind of an insider's approach to commercial real estate investing from a brokerage standpoint and an investor standpoint. And so, kind of three topics that I thought would be very helpful to think through is evaluating new markets. So, if you're in a state that you're not able to or you do not invest in, and you need to evaluate a new market, so what do you think about, and what should you be looking for? The big question that I get a lot too is in real estate investing, should I be active or should I be more of a passive investor? What are the benefits and downfalls from each? And then if we have time, how to create deal flow. I do a lot of talking about off-market opportunities and how to create a system of deal flow for your commercial real estate investing. And frankly, being a broker, obviously I have a lot of insight into working with clients and how that deal flow is created. But before we jump into that, I just thought that it'd be helpful to give you guys an idea of who is speaking to you today. So that's what I'm going to do first here. I'm a Midwestern boy. I live in Missouri. I grew up in Jefferson City, Missouri, which is the capital here in Missouri. Not a lot of people actually realize that or know that. And I'm a big reader. I really like to read personal and professional development books. And one of the books that I read was Carol Dweck's Mindset book. I highly recommend her work. But basically in the book, she said there's two mindsets. There's a fixed mindset and there's a growth mindset. And I characterize Jefferson City, Missouri as more of a kind of a fixed mindset mentality. And so I've never really fit that mold. So I've always been looking for more. And I identified as an athlete for so long. So I obviously, Daniel hinted at the fact that I was a football player. And so during high school and college, I played football, and I got picked up as an undrafted free agent with the Oakland Raiders. I did not make the team, but I did beat out a few folks who were drafted. So that's my claim to fame. When I was cut, I decided to go back and finish my master's program at the University of Central Missouri in Warrensburg, close to Kansas City, where I reside now. I lost over 120 pounds in 6 months. I had a full-time job. I was going to school full-time. And I also lost my father to drugs and alcohol addiction during this period of time. So you can imagine, a 24-year-old man who was no longer an athlete, lost all of this weight, had a new identity, and lost my father all at once. So I really had an identity crisis, I would say. And that's where I started to really dive back into reading. And that's where I got into real estate. And so about 4 years ago now, I got fired from my job. So I had a full-time position, but I was fired from that job. I decided to take the plunge full-time into real estate. I took a position as a head of acquisitions for a $50 million fund here in Kansas City that was buying single-family homes. And basically our methodology was doing what I'm sure many folks here have been exposed to, is the buy, renovate, rent out, refinance, and repeat model, that kind of BRRRR methodology that Bigger Pockets made so popular. Well, we just did that at scale. So we did that over 265 properties. And I really got to learn about how to create off-market deal flow and negotiations. But what I also learned was a word that I had not heard before, because what we did was we basically added enough equity and appreciation in this portfolio to do a whole portfolio core vest refinance. And all that means is we were able to return 85 to 95% of the investor's capital, and the whole portfolio still cash flowed, which is a big success, right? And when I sat down with those sponsors, the folks that I represented, I wanted to know how they structured it. And that's when they really started to say, this was structured as a syndication. Well, that's just not a word that I had heard before. I was an operator. I was out there transacting real estate. I didn't know what syndication really was. And so I decided to move my license to a commercial and multifamily brokerage here in Kansas City, one that Daniel knows very well. And frankly, I started to do the BRRRR methodology on multifamily properties, which got me really exciting. And I started to work with out-of-state investors who did not have a presence into Kansas City. So many folks that lived in Colorado, California, some in Florida, and then up in the Northeast. It's interesting. Typically, West Coast investors come all the way over to Missouri. East Coast investors stay on the Carolinas and go to the Atlanta submarkets. But long story short, I thought there was a big need for folks that did not have a presence in Kansas City to help them with identifying properties and then helping them through the whole due diligence process. And so now what I do in Kansas City is we have a real estate investment firm. We own close to 1,000 units that we own and operate here in Kansas City. And I'm still helping out-of-state investors purchase large multifamily and commercial properties on a regular basis on the brokerage side. So one thing I wanted to spend some time with here, guys, was talking about how to evaluate that new market, what to look for and what to avoid. So I put some thoughts together here, and I think you'll find these quite valuable. And we're going to start here. This is one of my favorite quotes. Wayne Gretzky is arguably one of the greatest hockey players ever, and he was taught at a very young age by his father to rely on his instincts, to anticipate the action on the ice, to skate where the puck is going to gain an edge over his opponents. And his vision and ability to anticipate that action on the ice was what made him great. He wasn't in the right place in the right time because of luck. It was because he was able to analyze and process everything in front of him that allowed him to be one step in front of everyone else. And so in commercial real estate investing, what sets the investors apart from the run-of-the-mill investors is the ability to anticipate where the puck is going and not where it has been. And so right now, everything is trending towards the heartland, the Midwest. We obviously have some other markets that people are interested in, like the Sun Belt and the Carolinas, but there's been a big push to the Midwest as where the action is going to be very soon. So with that being said, I can speak to obviously Kansas City very well, and I will do that here in a second. But before, I thought we might talk about migration. And everybody thinks about migration only from a one-faceted approach. I look at migration with 4 buckets. We have worker migration, tech migration. I'm always tracking venture capital, and then investor migration. A few of these I obviously have a little more exposure to than others. But let's start with the worker migration. So since the beginning of the COVID-19 pandemic last March, many city dwellers who saw their incomes pinched due to the pandemic, they started to look for more affordable housing in less crowded local locations, with lower costs of living. And many workers whose jobs were converted to work from home positions were no longer confined geographically and saw no need to stay in high rent places like New York and LA and other coastal towns, where they could live in the same place in the heartland, in the Midwest, for about a third of the cost in New York City and Silicon Valley. So we've seen a decent amount of migration from some of the larger cities. And one way that I like to track this is the statements that I'm going to make are typically backed by empirical evidence and data, guys. So I track U-Haul's one-way tickets. And I think I posted this on LinkedIn recently, but U-Haul basically analyzed where people would grab a big U-Haul and have a one-way ticket to a new market. And Missouri was 7th on that list out of the 50 states. So, I always want to make sure that things that I am mentioning are backed up by data like that. So the second piece, obviously, is tech migration. And although United States tech companies have long outsourced work or set up satellite locations overseas to save money, we're starting to see kind of an emerging trend. And that's been to move operations to lower cost areas of the United States instead of overseas. And so the United States, the New York Times identified the Midwest as a hotspot for tech outsourcing. One thing that's interesting that Kansas City has started to get known for is called the Silicon Prairie, believe it or not. It might sound funny to you guys, but that is a name that we are starting to adopt here. We have an interesting startup scene here. We have something that's called the Startup Village. We have the Kauffman Foundation, which are all helping kind of startups and entrepreneurs get the resources and capital that they need. So although outsourcing overseas is still a lower cost alternative, outsourcing to the Midwest has advantages over overseas operations, including reduced issues associated with time zone differences, cultures, languages. We all know those things. I'm sure Adam Adams talked a lot about working with virtual assistants, something that I do on a regular basis too. The third point here I want to make is about venture capital, which is also following the tech migration from the Silicon Valley into the Midwest, and viewing the Midwest as undervalued. Big-time venture capitalists like Mark and Chris Olson from Silicon Valley firm Sequoia Capital, which I'm sure everyone's heard about, is they're leaving California and setting up shop in their funds in Silicon Prairie, aka Kansas City in the Midwest. So venture capitalists are seeing the Midwest as flush with opportunities, opportunities that are mostly undercapitalized. One thing that I always am harping about is taking a value based approach to investing. Howard Marks is one of the guys I like to follow. I read a lot about Charlie Munger and his investment thesis, and we see that kind of happening from the venture capital side of things too, as they see the Midwest flush with opportunities that are really undercapitalized. And so, according to a website I like to follow, the hustle.co, the Midwest is home to 150 Fortune 500 companies. So 25% of all United States computer science graduates and 60% of the country's manufacturing base. It's a large market. It makes up about 19% of America's GDP and is rife with innovation. So 19% of all the United States patents here in the Midwest. But it only accounts for 5% of all venture capital funding. So that undercapitalization presents venture capital firms the value propositions that offer lower entry points with higher upside than might be available on the coast. The last item here to chat through is the investor migration. So I'm sure everyone knows what a cap rate here is, and people like to track cap rates, but a lot of investors are tired of those diminishing cap rates on the coast from the institutional and foreign investors. They're flocking to the Midwest, where similar properties can be had at cap rates sometimes 100 to 150 basis points higher. And that's attracting a lot of investors from California, Denver, Colorado, and I would say probably some from Arizona, while there's still some good opportunities out in Arizona. But according to CoStar, research that they've done, all of the multi-tenant pads in the Midwest sold at below a 7% cap rate recently. Approximately 65% of those properties were sold to a California-based buyer. So similar metrics can be seen across single-tenant assets and multifamily assets as well. So I really think the future belongs to those who anticipate the trends and are capitalizing on them. And the future belongs to those investors who see all of those trends pointing to the heartland and other areas in the United States to invest in. So with that being said, I'm going to take these four decision filters here, or at least trends that we've talked about, and apply them a little bit to the market that I can speak to the best, which is Kansas City. So, and obviously this is just in one example. And I love Kansas City, obviously, but there's a lot of other great markets to think about when you're investing in commercial real estate too. So what are those criteria that we're really taking a look at? It's unemployment, it's job growth, it's affordability, population growth, and price to rent ratio. Probably seen a lot of these types of metrics in the past, thinking about looking at new markets. But I'm going to talk to Kansas City because that's my expertise. So financially, the toll exacted by the coronavirus on Americans has been devastating. After dipping to about 3.8% in February of last year, the lowest on record, unemployment shot up to the pandemic peak of about 14.7% in April. It has since fallen, but it still lingered at a high level, 6.7% in last November. Kansas City is sitting right around 4.9% on the unemployment rate last time I checked the data. But as that data trickles in, the numbers are confirming to me what I've known all along about Kansas City, that it has a strong underlying economy. It was strong before the pandemic, and now there's data showing that Kansas City and Missouri in general were some of the most resilient during the pandemic. And it also is showing signs of being among the most areas most poised to bounce back the quickest and the strongest. So one thing I would love folks to do when they're looking at new markets is figure out how the market that you're interested in investing in has basically performed the last 12 months. The great part about where we're at now from an investing standpoint is we have data to actually make informed decisions on. So I think that we're in a really good place as investors to figure out where that puck is going, so to speak. Well, let's jump on the other spectrum of that, which is employment and job growth. So the total employment in Kansas City increased by 8,500 workers in 2019, which was a growth about 0.8% for the area's ninth consecutive year of employment growth. And that rate declined to 3.3%, like I mentioned in March, just before the pandemic, which was the area's lowest since 1999, by the way. Kansas City's unemployment rate was a half point below the national rate. So I always like to take the market that you're taking a look at and evaluating and looking at it from a national standpoint, but also against other similar markets, because it can be somewhat subjective when you start to look at Kansas City against Los Angeles or New York City. That data comparison doesn't make a whole lot of sense, but Kansas City maybe compared to Oklahoma City, that's a really good comparison to make. So strong job growth translated to strong multifamily and commercial real estate numbers in the Kansas City metro. By the end of 2019, vacancies here had dropped to 4.5%, which was a 50 basis points drop in 2019. So that obviously translated to strong rent growth, where asking rents rose 3.8% in 2019. But the question remains is, how did rent growth happen, or what was rent growth in 2020 during obviously COVID-19? I really like the idea of saying, okay, there were some winners, not winners, but not losers per se, in 2020. And that gives you a really good snapshot of trying to understand what is actually the underlying factors of these economies. So let's jump into how did the region fare in comparison to the rest of the country during the pandemic. And it was better than most. We've talked about the unemployment rate here, peaking at 14.7% on a national standpoint. We peaked here at 11.7%, which is a full 3% below that national rate. So, and a lot of people like to ask, well, what is that resilience explained by? And it's, by a Missouri economy composed of diverse mix of industries. So we have transportation, manufacturing, agriculture. We're getting a new airport here, which is just going to be, I think, really great for this area. So it's not solely dependent on one or more sectors. And that translated to lower economic vulnerability to the pandemic than almost any other state. And let me back that up with some data for you guys. Hopefully you like data like I like to do, because I don't like making broad statements. But according to a June study conducted by Wallet Hub, Missouri was ranked 49th out of 51 states, with DC being included, most exposed to coronavirus. And these states were ranked by the levels of highly affected industries and workforce. And so basically, understanding that Missouri's ranking lower in the former and the higher in the latter gave low vulnerability ranking. And as for the effect of the pandemic on the Kansas City multifamily sector, the rest of the country saw rent declines in 2020. I think there was about 6 markets that had positive year-over-year rent growth, Kansas City being one of them. It was a small increase, but it was still a 1.1% increase. And we saw that happening in our own portfolio as well. So it was nice to see the data trickling in from these resources, but then applying that same comparison to our own portfolio. And so then that has me thinking about, okay, well, what do we have as an opportunity here in Kansas City in 2021, in the Midwest in 2021? In another ranking done by Wallet Hub, it compared cities whose unemployment rates are bouncing back the most. Kansas City was ranked 17th out of 180 different cities. And again, I think it's that underlying economy that's really driving opportunities here, which obviously creates opportunities from the investing standpoint. So we've talked a little bit about unemployment and job growth. Now I kind of want to switch over to affordability and something that I like to really think about, which is the price to rent ratio. So let's talk a little bit about how much rent is affordable. So kind of a rule of thumb here, right? Maybe you've heard that you should spend no more than 30% of your annual income on rent. Spending 30% of your yearly income on rent is widely believed to be about an affordable amount, leaving you enough money for all of your other expenses. And I'm gonna do some math here with you guys. I'm sure there's some statisticians here with me. You might like this. So you have 2 rules here. We've got the 30% rule, or what I call the 40x rule. So what's the difference between the 30% rule and 40 times the monthly rent? There's nothing different from that. There's just 2 different ways of deriving that same number. So the 40x method is just as easy to calculate. So for example, let's take $120,000 worth of income and determine how much rent somebody can afford. So 30% of $120,000 is $36,000. Then you take $36,000, obviously divided by 12 months, and you have $3,000 per month. If that's too much math for you, there's an easier calculation. Just divide 120,000 by 40, and you get $3,000 per month. So if you didn't learn anything else other today, I just taught you guys some math. Hopefully that was fun and helpful. So, Daniel, I think that I've got another sector or section of the presentation to go through, but I would like to pause there and open up any questions that might have come up about how to evaluate a new market.
Yes, I've been tracking those questions for you. And so I'm gonna do three of them, and then maybe we could open it up for 1 or 2 minutes, maybe 3 minutes, depending on people, just to ask their own questions.
Sure.
The first question was from Veronique. How do you get access to U-Haul data?
Okay, so one way that I aggregate email, right, is I'm on a bunch of newsletters and I set up a new email address and then I use something that's called now the app that I actually use is it's called unroll.me. Sorry, that's exactly what it is. Unroll.me. So basically I subscribe to all these newsletters in different real estate investing kind of informational sources, and then I get one email a day from unroll.me that basically has all of these emails in a snapshot, and I can click the one that I want to open or unsubscribe from, which is really great. You can unsubscribe from a lot of different things at mass. So anyways, that might be a productivity hack there. But in one of those emails, I track this this newsletter. It's just called Real Estate Investing Today. And it's a newsletter that sends out daily, and they actually had the infographic from U-Haul. I'm not sure if U-Haul potentially put out a report or somebody just did the data analysis themselves, but it looks pretty credible. What I'll say from U-Haul, it looked like something that U-Haul had put out, and there was a little infographic that showed kind of the one-way tickets from where people were moving to.
All right. And I'm not sure if you just answered this question, but somebody else said, can we get a list of good places to get market data or research?
Absolutely. I have a full list of different resources that I am tracking off the top of my head. There's a few. National Multifamily Housing Council is great. The Urban Land Institute is another great resource. MHN News, which I think is just multi-housing news, is one that I track very, very closely. But just being involved here in Kansas City, I actually learn and get a lot of great information on the commercial real estate side of things, development, that type of scenario through our local Kansas City Business Journal, believe it or not. And you can subscribe to the market that you would be into. That's an insider's tip here, Daniel. I would say that if you're interested in investing in a new market, go pay for a subscription on the Business Journal. They have a commercial real estate section, and typically they have a great resource kind of database that is creating those reports. But also, I would also recommend going to some of the large brokerages. So Berkadia, CBRE, and maybe even Marcus and Millichap, depending on who is involved in the market that you're interested in evaluating, and signing up for their newsletter. On their newsletter, they have some of the best researchers that I have found. So I'm on all of their newsletters, and when they have a new market report that has all of this data, it's a fantastic way to get a snapshot of how that specific market is performing.
And then two more that I'll add to that list too are for the people that love data out there. These are free resources, city-data.com. Lots of people, well-known people, I believe Neil Bawa does his free analysis on citydata.com.
Yep.
And bestplaces.net. Really good for getting an overview of a particular area if you just want to look at crime or schools or other types of stats. It gives a really good and very readable breakdown of an area. And you can search by zip code.
Absolutely.
All right. And this might be a slightly bigger question than we have time to dive into, but sure. Abisha wanted to know, you listed your criteria that you look at, but what ranges do you consider to be good in those criteria?
Yeah, let me go back to those really quickly. Okay. So one thing I would say is you always want to start with the national averages. And then I like to break it down into the region averages. So obviously giving you a rule of thumb on unemployment, job growth, affordability, population growth, and price to rent ratio is somewhat difficult to do from the last 12 months. I would actually take out the last 12 months if you're not looking for what's happening in a market currently. If you're looking for historical averages, I would go back to 2019, 2018 to start to take a look at that. And I always look at 5-year snapshots anyways. From an unemployment standpoint, obviously the national average was around 3.8%. So Anything below that is obviously beating that, but sitting somewhere around there is probably where I would say is where I would want to be at. From a job growth standpoint, this can be very specific to the market that you're in the type of jobs that you're actually looking at. City Data, I believe, does a great job of breaking some of that out. I can't necessarily give a really great rule of thumb on that. Population growth, however, just from a standpoint like Kansas City since 2010, the population growth here has been 6%. The national average has been 5% from a population growth standpoint. So I would say somewhere between 4 to 6% would be a great place to kind of be at. Affordability, that's one piece that we look at from the price to rent ratio. So looking at median average incomes and then finding out what the rent is in those certain submarkets and doing the price to rent ratio calculation yourself. And then population growth, yeah, I guess we've already talked about that. So hopefully that was helpful. I think I maybe addressed the question there.
Yep. And so far, I don't think we have any other questions. So let's continue with your presentation, and then at the end, we can open it up.
Okay, great. So one of the questions that I get in being a broker and an investor is, should you be a direct or indirect investor? Another way to think about this is active investor versus a passive investor. And we're only going to scratch the surface here because it's really a specific answer for each person that I speak to. But I have about 45 new investor calls per week. So I've really kind of honed in what I look for. And I've broken those down into, I believe, 4 factors to kind of think through. But if you're new to real estate investing, this is definitely something you want to start with. And you can take advice and recommendations from others. But again, ultimately, it's going to be a question that you can answer. I'm going to give you a mental model, or like Charlie Munger likes to talk about, a lattice work here to think about this question in. So let's define what the difference is before we dive into how we break out the questions. So direct investing is direct ownership of a real estate asset. Just simply means that you or an entity that you created, I mentioned, somebody was mentioning LLCs beforehand, that they own the title as well as the owner of the property. So direct ownership also means that you're responsible for every aspect of the investment life cycle. So you got to find the deal. You have to put it through the due diligence. You have to find the financing. You have to complete the acquisition, any renovations, management, and then obviously doing the asset management and disposition of that. So that's where I say the difference from being in the business of real estate investing and being a commercial real estate investor. You really have to delineate between the two. So being in the business of commercial real estate investing would be direct investing. Being a real estate investor would be more of the indirect investing side, which is indirect ownership in an investment property. So instead of acquiring that property directly through your name or your LLC, you actually invest in a fund or an LLC that owns that real estate, that has fund managers or property managers or a sponsor, general partner. These are all terms that are kind of interchangeable, I would say, in the space. They oversee those various aspects of the investment as discussed on the direct investing side. So that's the difference between active versus passive, or direct versus indirect. And let's dive into the 4 factors that you should be taking into account when deciding to be active or passive. The first one is control. And this is one that is near and dear to my heart because I like to have control. And I'm sure many people on this call may feel the same way. But for many investors, the question of whether to be direct or indirect and it just comes down to control. Investors who want to invest directly typically want to keep control of every aspect of their investment. They may outsource certain functions like construction and contracting, but ultimately they oversee everything. Having greater control also means the flexibility to pursue a particular investment strategy and how to achieve those objectives. For example, a direct investor can select properties with predetermined criteria based on factors such as location, property type, access to a variety of crucial data on that asset, including tenants, physical asset condition, and the operating performance. So Having direct ownership and keeping operational control also means keeping control of all of the profits. And so that's one thing to think about. There's obviously benefits, excuse me, of being an active investor and having all of the control. But at the same time, you really have to think through, do you have the time, experience, and knowledge to do that, or even the want, right? That's kind of where I get back to asking people about their goals and how to try to accomplish those. So that's the first kind of framework that we go through. The second is the learning curve. So there's obviously a lot less learning curve with indirect investing in terms of operating the asset. There's a whole other type of learning curve by being able to evaluate the sponsor or the owner of the fund that you are interested in investing in. But fund managers have already typically learned the ropes and jumped through the hoops of real estate investing, not only in general terms, but also specifically with particular types of assets, different types of segments, investment strategies, and geographic locations. So the learning curve for a new direct real estate investor can be steep, requiring significant time commitment and perhaps significant capital to pay others to acquire that knowledge through materials, attending workshops and seminars to learn the ins and outs of real estate investing. With indirect investing, somebody has typically already gone through that learning curve, freeing you of the time and capital commitment of overcoming it on your own. Now, again, like I mentioned before, there's a different type of learning curve of making sure you make the right choice with the right sponsor that you're looking to invest in. The third factor to take into account here is personal risk. So as an indirect investor, your personal liability for the fund's debts, obligations, or even civil liability is limited to your investment capital typically. As a direct owner, whether holding title in your personal name or in an LLC as a general partner, you may not be able to hide behind the wall of that limited liability, especially if you're accused of some sort of fraud, abuse, or any other type of litigation. So without the protection of that liabilities, creditors and plaintiffs may be able to pursue your personal assets to satisfy their claims. Daniel, you probably had somebody on talking about asset management. And that's where we really start talking through that whole functionality of commercial real estate investing. But in connection with bank financing, first-time investors will often be asked to personally guarantee a commercial real estate loan to protect the bank's interest. Even with strong loan to value, you have to still personally guarantee a lot of these smaller assets unless you're able to acquire agency financing, which is not always available. So when considering the personal liability and loan underwriting criteria, direct investing adds another layer of potential liability and financial risk not found typically with indirect investing. The last one that we're going to kind of cover is diversification. And diversification is a word that's thrown out there a lot. Obviously, everybody's heard the word, but it can mean a lot of different things. So diversification through indirect investing is the idea of not placing all of your eggs in one basket, and the goal is to spread out the risk of investing. With direct investing, because of the significant capital outlays of acquiring an asset yourself, you're typically limited to acquiring one or two properties under your portfolio, just depending on your specific scenario, obviously. But indirect investing allows you to open up opportunities to invest in funds, in different types of syndications across a variety of variables, including market segment, strategy, compensation structure, the lockup period, capital commitment, and the geographic location. So let's go through a quick example here. Imagine you had $200,000 to invest. You could put that all in one investment, or you could spread that across, 4 $50,000 investments in those funds or different types of projects across different asset classes and different locations. So a general market downturn may affect one of those income streams, but not all of them, ensuring you have the continued cash flow through a recession. So if you have high risk tolerance and don't mind concentrating your portfolio on a small number of assets to maximize your potential returns on a per asset basis, direct investing could be the right option for you. Or if you're even going through a 1031 exchange, something that I focus a lot helping our clients go through. Obviously, you don't have the opportunity typically to diversify that income unless you go through the Delaware Statutory Trust or a deferred sales trust, which is even more confusing because there's two DSTs out there, which frankly is is a very confusing notion. But Daniel, if you ever want somebody to talk about deferred sales trust, the other DST, I have a great person to introduce you to if he has not already spoken here. So what is the bottom line? I think the decision to become a direct versus indirect investor typically comes down to three questions. How much time and energy do you want to commit to your investments? How much capital do you have to invest? And are you willing to commit to the education required to become an active investor? The appeal of indirect investing is the avoidance of headaches. The savvy, affluent investors with little time to spare because of business and career demands, the indirect route is often preferred. For investors who have time to spare, willing to take on the financial risk, and make the personal sacrifices to make it on their own, the direct route is often appealing. And I work with both of those. So let's bridge the gap a little bit. Because if you don't have the time to be a direct investor, but you also want to enjoy the benefits of being one like enjoying higher rates of return and being able to tailor your investments to fit a certain investment strategy, what if you could enjoy the freedom of being an indirect investor, but also have a say in and how your capital is used? And the good news is that it's possible because of the transparency of most private real estate firms and funds, where they make themselves available to potential investors to answer questions to address those concerns. So through proper due diligence and interaction with those managers or general sponsors, partners or sponsors, as an indirect investor, you're still able to control the direction of your investment by aligning your interests with the interests of the sponsor, the deal that you're investing in, which gives you the benefits of both worlds if done right. The hands-free aspect of indirect investing combined with focused strategies and returns of direct investing. An interesting, I think, example of this is simply many times 1031 exchange investors are looking for a more passive investment, and they start to think about tenancy in common or TIC projects, and or they complete a 1031 exchange and they see what some of the other indirect investing routes go, and they say, well, man, I'd really like to get exposure to that. So a lot of active investors turn to passive investors. And I also have the flip side where somebody might be a passive investor in a project, but have that want to become a general partner themselves. There's no really one size fits all approach here. It really has to come down to those three questions that we talked about. So that being said, Daniel, before I continue to talk, because I could talk about this quite a bit, I will go ahead and pause there and see, and I know we're coming up on time too, and see what questions we might have to think about.
Okay, we have a couple of questions. Honestly, not too many. Quite a few people are IMing me privately. If you've got a question for the group, definitely send it to the group and not just to me. Okay, so one of the first ones here: where can you find ratings and reviews for sponsors?
That's a good question, and I do not know necessarily one aggregated resource for people to find ratings and reviews of sponsors. What I do know is there are some private investing sites that have some sponsors on there, their track record and things like that. I don't know the names of those per se. Maybe you do, Daniel, and you can provide those. But what I would say on this standpoint would be it's going to take a little bit of time, and it's going to take a little bit of time on your part to do the due diligence to make sure you understand what the track record is and what the quote unquote ratings might be. One thing that I get asked quite a bit when we're talking to new investors is simply, can I chat with some previous investors in your projects? And that's a great question to ask. You know, sometimes you have to be somewhat cognizant that investors do not want to talk to other people, and that's fine. But typically, if you're doing a good job as a general partner and a sponsor, you're going to have investors that will be advocates for you. And so I have some advocates for our projects that I make available to other investors. But it's really simple to ask for the track record to see how the previous projects have performed over time. And you can get a really good sense of that by asking those questions. We didn't get to it here, but I wrote an article that I can send to Daniel that I think helps people evaluate new sponsors. I have the 7 questions to ask every single sponsor. I'm happy to send that over so you guys can digest that information as well.
All right. Henrique is asking, what rates of returns are you talking about in Kansas with indirect versus direct investing?
Yeah, it's a great question. So I would say typically an indirect investment, you have to think about it from a risk profile, right? So different firms are going to have different investment theses. And I touched on ours earlier, being value investors. So typically we focus not so much on core and core plus assets, which are newer assets with long-term triple net leases and or class A. We tend to focus on kind of the middle of the run, class B and C multifamily assets that are quote unquote in the value add to opportunistic space. And so one, I would say, think about the asset class and your risk profile. That's the first, because each one's going to have historically different return profiles as well, which needs to align to your investment goals. The value add and opportunistic projects in Kansas City, return on investment kind of metric that we typically use is an internal rate of return on a 5-year hold. It's anywhere between 17 and 22% based on the risk profile of that property. And if you were to go purchase an asset by yourself, I think you could probably get very similar returns if you have a good deal flow kind of system set up, which I'm going to tease the next. I'll make these slides available, obviously. We didn't get to talk about this, but if you want to be a direct investor, the one choke point or bottleneck that you are going to have is finding good properties to purchase. And one way to overcome that is to build relationships with brokers, something that Daniel is very good at. And so, frankly, we didn't get to touch on this, and I'm sorry I can't dive into it in more detail. Go ahead.
Oh, Logan, I just wanted to throw out there too. When you're talking about multifamily, I see on your brokerage site lots of smaller multifamily. 8 units, 16 units,
Absolutely.
things that, as you mentioned earlier, with a 1031 exchange, you can take a home, in California or some highly appreciated market, 1031 exchange that into an 8-unit or a 16-unit. So when you're talking about multifamily, you're not talking about something that's that takes a huge team and a huge organization.
Right.
A small team or even an individual could move into those types of properties that you're talking about.
Absolutely, 100%. I would also add that. Oh, sorry. Go ahead.
Put your contact information on the on the slides. Somebody's asking for it.
Oh, excellent. The last slide here has some contact information for me if you want to learn more about what we've got going on in Kansas City. But one point I wanted to make on that front is simply think about return on equity. And what I mean by that is I get exposed to so many folks that maybe bought a single family home that they moved out of because they grew out of it, but they kept it and they have a renter and they have a resident in that property. But they've also seen large amounts of appreciation over the last 5 years. And so take the equity that you have in that property, which needs to be calculated with your CPA, but you can find out what your basis is in that property, and you find out what your free cash flow is based on that return, and you divide those two numbers. And return on equity is a very interesting return on investment metric to think about when you're in a highly appreciated market. Many times people might be cash flowing $250 or $350 a month, but they might be sitting on $500,000 of equity. And in that example, you could do a 1031 exchange, use the $500,000 or more, depending on what your basis is, as a down payment on a 20-unit apartment complex here. So your return on equity really just went from 1% to potentially 14, 15, 16%. So it's kind of an eye-opening experience to go through. But I would definitely say that's one thing that I would be thinking about if I had some equity in a property in California or another highly appreciated market, Daniel.
All right. I hate to drop this question on you in the last 3 minutes, but it's one everybody asks. We have 2 of them around here. Let me read both of them really quickly, and then we can do a summary of it. The housing market's very hot, for example, in Phoenix. Do I decide to buy now or later? Any suggestions? And then the second question is, also, we've had the longest stretch of housing prices going up in history. Normally, we've seen housing prices drop every 5 to 8 years. We've not experienced that in the last 12. Where do you see the market going? Do you expect a drop anytime in the near future?
Sure. Well, I think the trend that I have been tracking is simply what is the cost of construction for a new property. So I can speak to Kansas City, but I understand here with the home builders that I know, some buddies that build homes, it's not economically viable for them to build a new house in Kansas City that's really under $300,000. And that might not seem like much to investors that are in California and stuff, but that is a pretty sizable home here in Kansas City where many people aren't able to purchase that. Typically, first time home buyers are somewhere between 150 and 250 on the top end here in Kansas City. So to go build a new home is very difficult to do it in the price range that people need to stay in. That being said, that trend could impact housing prices. Again, Kansas City, I'm watching single family homes in good locations continue to sell at prices that were much higher. I actually sold my personal residence late last year for about $90,000 more than I purchased it 3 years before. And in Kansas City, that's unheard of. So this is all to say I would track the trends of what it costs to build a new home, who is actually living in those markets, and try to understand if new houses could be built. That might give an insight a little bit to home prices and if they're going to continue. To touch on if it's the right time to purchase, if it's the right time to purchase an investment property, yes, I think there's a very good perfect storm of folks looking for assets with intrinsic value, meaning they do not are not dictated by market pricing per se. There's an intrinsic value, so the income streams on those properties, they have a value to them outside of what somebody else is willing to pay, unlike potentially a single family residence. So I can't speak to, I think, anybody's personal specific scenario, if they should go buy right now or where their current market is going to be in Arizona or California or Oregon or anything like that. But hopefully a really good realtor in that space might have some insight into that. But I hope I kind of unpacked a little bit of the trends that I'm looking at least in our market.
All right, Logan, thank you so much for coming and sharing with us. And I want to encourage everybody to reach out to Logan directly if you have questions. I also want to give a quick shout out to Jessica Truman, who showed me how to make the SharePoint public. So hopefully there won't be any more problems with that.
Well, thank you guys so much for having me, and I appreciate it, Daniel.
Thank you. Logan, do you mind if I do a follow-up call, or do you have another call scheduled?
No, I have plenty of time.
I'll give you a call.
Talk to you soon.
Bye.
Try to figure out how to stop sharing my screen here.